Greetings. This is Dan O'Brien. I'm an extension agricultural economist at Kansas State University. I myself, along with Gregg Ibendahl, have brought together some information for you on oil and energy market analysis. We are recording this on Wednesday morning, April the 22nd, using data from about 11 a.m. And the way these markets are moving, it pays anymore to say what the day and time is that you're talking about outlook information. Big happenings that occurred in the crude oil markets this week. We're following up with this video on what happened in the May 2020 contract. On the closing date of that contract, which was Tuesday, April the 21st, we saw after a long-term downtrend and after most traders had gotten out of that contract, you can see that by the volume numbers from this DTN chart. I'd seen on Monday, the 20th, that we had what they call a long squeeze. Those that were the short sellers that were delivering on that contract, you'd made money as all that had gone down, were delivering onto the longs. The longs did not want to take that because there's lack of storage space at the delivery location, Cushing, Oklahoma, or anticipated lack of space. So they were so anxious not to take delivery that they were paying others to do it. So the price went negative. And it traded as low as $40.60 negative on Monday the 20th, ended up at $37.63. It is interesting that by the time we closed trade on the last day, that we closed back up to $10 to the positive side. And so it's interesting and important to look at what was happening in the June contract. Well, it had been affected by some of the same downward trend, and had seen volume come into that contract, and as we and this is yesterday's chart. When you look at what happened today, what's happening by midday, the volume's vastly greater than even that. But note on the 20th, on Monday, when the May contract had been so negative that this one, that the June contract is $20.43 to the positive still. Did close 11:57 then on Tuesday, and as of Wednesday morning, about 14:57 thereabouts. Really, what's amazing is the spreads. The June-May spread on the 20th, with June at $20 over and May at 37 under, is $58. By the time we closed on the last day, we were back to a $1.56 spread to the positive. And looking out to the June-July contracts, again, 585 to 712, something like that for spreads, much more of a normal situation. When you look at the oil futures complex, we're looking at West Texas Intermediate oil. There's also Brent oil futures traded elsewhere. They did not go negative, by the way. They're cash settled, whereas this is physical delivery settled, and that was big part of the issue. Very bearish oil market outlook for this year. You can see, yes, some positive carry in those markets. You see volume in the front end. We do have a contango forward carry. We're carrying charges in the oil markets, but here we're at 14.57 in June per unit. Go up to 29.42 by the time we get to December. Carries all the way, and really, and if we look at break evens, $40–50 for a lot of shale oil production in the U.S., then these are doing nothing to encourage production. In fact, they're leading to shutdowns. What'll happen in June when the June contract gets towards expiration? Very likely that the CME will be monitoring that closely and make sure that any long traders that are there, and there are some, no doubt. There has to be two sides of the trade. Any long traders will be out of that position, and long or short, they're just not going to. You would think they'd want to avoid the same situation happening in the expiration of the June contract that happened in the May contract. Big overall picture, of course, is that U.S. motor gasoline product supplies are down because demand has fallen off so much from coronavirus impact. And so basically, latest U.S. Energy Information Administration info showing that we were at a high of about 10 million barrels per day of motor gasoline products supplied, and now we're down to exactly half of that, 50% contraction. And gasoline and diesel prices have suffered in kind. You can see diesel, regular gasoline below $2 now, diesel at about 250 thereabouts. Gregg Ibendahl's put together some information that basically would show that where oil prices are at now would be consistent with diesel prices historically below $2. And so all this, on the one hand, it's a very, very positive thing for users of diesel fuel, but you have to see the unwinding, loosening up of the U.S. economy in coming months to see a lot of change in that. So I appreciate the chance to speak with you on these issues. And Gregg, myself, and others in KSU Economics will continue to put out information that pertains to trying to explain and understand what some of the forces are that are affecting these grain, livestock, energy markets at this time. Thank you very much.